In recent days, particularly since the market took a turn in pricing, we've seen guests be a little less concerned about the labour market than they had been before this data blackout. You are still concerned about the labour market. Explain why.
Good morning, and thanks for having me. Yes, I think that, what you have seen in the data lull is that some of the second-tier data indicators, also some of the private sector indicators, have still indicated a tentative signal that the layoff rate is beginning to pick up. And I think that's important because what you had going into the shutdown was a labor market where you didn't see a lot of hiring, but there was not that much concern around firing. And I think what I am looking to see in the upcoming reports is whether those tentative indications that layoffs and the layoff rate is beginning to pick up is actually something that is borne out or substantiated in the full set of payrolls and household survey data that we get. I think that's the key thing to watch.
So you say that this is going to lead to dollar weakness, Kamakshya. The administration won't be too pleased about that. Is there something that can be done?
Look, I think that the dollar weakness is a function of the fact that, our view that, the U.S. economy and markets are less exceptional than they have been in the past. And as a result of that, the dollar no longer warrants its very rich valuation. We've already seen that valuation erode to a significant extent, so far this year. We think there is more to go in that. And that's just a reflection of the fact that we think the Fed is going to be easing policy more in December, again next year. That's something I think that is consistent with some of the views that the administration has expressed. And on the other hand, we don't have quite as much easing priced into the rest of the major G10 markets, with the exception of the UK. So it's really the US where we are seeing this combination of somewhat softer data and, more significant, deeper policy easing, which we think will keep the dollar on the back foot.
And of course, I imagine that if Kevin Hassett were to be the next Fed chair, that wouldn't change your thesis in the slightest. It would add weight to it, in fact.
Yeah, I think it's one of the additional reasons why the skew to rates in the U.S. might be, more towards deeper cuts rather than the other side of the distribution. I think that there are a number of forces pushing in that direction, the weakness in the economy, the fact that, you might also see some of the worst tariff impacts on inflation pass into the rearview mirror as you go through, the early part of next year. And a reshaped Fed might add to that impulse in direction of weaker rates and a softer dollar.
I want to ask you about the yen, because we saw a little bit of relief today. Obviously, it's back below 156, but I mean, that's still pretty weak for the Japanese yen. What happens if we get this hike in December?
Yeah, I think that is probably one of the things that is actually pushing the BOJ towards a potential hike in December. Remember, they were looking for two things to feel comfortable about hiking. One was that the U.S. economy, while it was slowing as a result of the sort of, aftermath of Liberation Day, but was not really going into a tailspin of any kind. That's definitely been confirmed in the last couple of quarters. And the other thing they wanted to get confirmation was that you had a self-sustaining wage growth trend. And you're beginning to see some early indication that may be playing out too. So I think those are the things that are pushing the BOJ to consider hiking in December. We've had a call for them to go in January for a long time, but I think they probably are feeling comfortable enough. And I think that's important because, we've seen the yen weakness, as you said. It's sort of weakened considerably further after the new prime minister. And, a weak yen is not popular in Japan either. And so I think you're going to see some pushback, both from the administration, but also from the BOJ against, an excessive amount of yen weakening from current levels.
Kamakshya, I have to ask you about your favorite currency pairs at the moment. Is there any way to play this global sort of, upturn in events? So we have, tariffs going on in certain countries and, getting lowered in other countries and so on. How do you play a scenario like that through the FX space?
Right, look, it's hard. I mean, as you're saying, you're seeing not just that it's going on against certain countries and going off against other countries, it's also within countries there are certain goods being exempted, certain ones not. So I think that those are hard trends to play out from a macro standpoint. But I think I'd say one of our highest conviction views related to this is we think that the CNY, the Chinese renminbi, is a currency that's going to continue to appreciate on a sustained basis. What's happened there is exactly in line with what you're saying. You had these kind of very high levels of tariffs threatened early on. There's now a détente. You have some more reasonable trade outcomes. And the Chinese currency is very undervalued in our metrics. As long as you have this combination of, good trade relations and very significant growth in Chinese exports that you are seeing, I think policy authorities there will be willing to let the CNY appreciate on a gradual but sustained basis. It's making new year-to-date lows every week. We've seen that this week as well. I think that trend has a lot further to run in FX markets.
And beyond FX, just in terms of your EM strategy, part of the portfolio, is China investable these days? I mean, we saw this huge run up for the stock market. Is there more to go, or would you be getting a little bit trepidatious right now?
No, I think there is more to go. I think that, certainly, China also provides, exposure to some of those high-tech industries that have been doing well in global stock markets across the world. So I think there's definitely more to go there in the domestic equity market. As I mentioned, I think the currency is on a more, stronger trajectory as well. We think that's likely to continue as well. And that's an important ballast or support for the broader emerging market universe. It's kind of hard for EM as a whole, particularly EM equities, to do well if China is not doing well. So I think that's important. I think there's also opportunities on the local rates market side in emerging markets, but that is more amongst the higher yielding countries, places where the rate cut cycle will get going, hasn't really got going. Brazil is the most obvious example. I think there's a lot of potential both in Brazilian equities and bond markets going into next year.